All right, welcome everybody. Thank you so much for joining us. If you're listening to us live, happy Monday. Hope you guys are all staying healthy. And thank you for spending a little bit of time with us today. This is the 2020 investment trends that we're seeing in the self-directed space. My name is Sean McKay, and this is an American IRA presentation. So this is a little bit different than some of the other content that we produce. This isn't so much mechanics of the do's and don'ts and things you got to stay away from with your self-directed accounts or going too deeply into particular strategies. This is really just kind of giving you a little bit of an inside look in terms of what we're seeing from clients in terms of their investments. Also, a lot of just kind of their thought processes on why they're making the investments that they're making. So the first and foremost, it should be noted that this is not tax legal advice, or we are certainly not acting as advisors. So ultimately, this is just really an articulation of different things that we're seeing in the market at this point in time, but it is always mandatory really to speak with your advisors, your tax and legal professionals to get their guidance as to how to structure a portfolio based upon your goals. So certainly for those listening, we are not privy to your particular situation, what you're trying to accomplish, nor are we licensed to give you any sort of advice for what to do with your self-directed account. These are certainly self-directed in every way, shape, and form. So with all that said, we'll go ahead and dig right into it. And so really, I think 2020, more than most years that we've seen, especially, especially over the last handful of years, is really a unique year. And it's probably a good time for us to take stock of what we're doing, why we're doing it, and make sure that we're tracking properly for what our goals are. And so ultimately, when we're talking about these retirement accounts, there's so many different opportunities for us to invest our IRAs and 401ks. And so really, we do talk a lot on other webinars about kind of the pandemic lessons that we've learned and things like that. But ultimately today, really just kind of making you aware that there are a lot of opportunities, whether the market's going up, the market's going down, the market's sideways. And so ultimately, we all just need to kind of stick with our core game plan and certainly make adjustments as new information comes to us. But it's a great time to kind of take inventory. And 2020, in a lot of ways, has been kind of a stress test for a lot of our portfolios to see how they perform in kind of thankfully, highly unusual circumstances with economies being shut down, with certain asset classes being adversely affected, others not so much. So it's really been a unique opportunity for us not to just think theoretically about how things would work, but to really have a perspective in dealing with the reality of 2020. So again, keep in mind when we're discussing these self-directed accounts, these are retirement accounts where you as the account holder are picking the investments for your portfolio. We are not advisors picking investments for you. It should also be noted, you have true flexibility with us at American IRA. You can invest in the stock market. We have a relationship with TD Ameritrade so that you can go online, you can pick your own individual stocks or bonds, mutual funds, ETFs, whatever your particular preference is. And then also really where we shine is with the alternative assets. So clients investing in real estate, mortgages, private placements, precious metals. We'll dig into a lot of these things today and kind of talk about how they've played out in this very unique year. So at American IRA, we're one of the few fully integrated self-directed IRA providers, meaning that we have the same ownership group for American IRA LLC, which is the third-party administrator, the record keeper for your retirement account. We are fully integrated with New Vision Trust Company, which is our parent company. It's the custodian for our clients' assets. And the reason why that's important to you is that the firms that are not fully integrated are constantly having to adjust and move to different custodians as the banking regulations change and as business models change. And this means that their paperwork changes drastically, sometimes on a year-to-year basis. We're very fortunate in being fully integrated and that we're going to be able to provide a much more consistent platform for our clients to invest. It also allows us to have far lower fees than almost everybody else in the industry. So our model is not to charge you more money each year as your account balance grows. We're able to cap it at a very, very low fee because we don't have the additional layers of overhead and third-party companies that are kind of driving the expenses for our clients. So we're very, very fortunate. Again, that's a value add for our clients at American IRA. It's also important to note that as we talk about these concepts today, all of these self-directed accounts can make these investments. So whether you're a small business owner that does not have any full-time employees and you have a great account called a solo 401k, high contribution limits, the ability to borrow from that 401k, kind of some unique tax advantages associated with that, or you have a Roth IRA or traditional IRA, a SEP or a simple IRA. We also offer Coverdale educational accounts. So if you have minors and you're looking to put money aside to pay for their qualified educational expenses, that's a great opportunity for you. And for those of you that perhaps have inherited a retirement account from a family member or a close friend, those retirement accounts can be self-directed as well. So there's a lot of opportunities with these investments. Now, again, we're going to unpack some of the more typical things that we're seeing in 2020, but keep in mind, when we look at the real estate asset class, almost any type of physical real estate can be purchased with your self-directed account. So whether it's raw land, condos, townhomes, single-family homes, industrial buildings, commercial buildings, apartment complexes, retail spaces, all of those investments can be owned by your self-directed IRA or 401k. Now, for the larger deals, sometimes clients will need to partner with other investors, maybe in a single purpose LLC, and that LLC can have members such as retirement accounts. So a retirement account can be the sole member of an LLC. Maybe you've heard about the checkbook control concept. You can do that with us at American IRA, or it can be part of a multi-member LLC. So your self-directed account can be one of 5, 10, 15, 20 plus investors in a single purpose LLC. We're seeing more and more of our clients that are investing in privately held companies as well. So it could be restaurants, it could be banks, it could be tech companies, whatever is out there that you deem to be kind of a appropriate risk reward scenario, those opportunities are available to invest in with your self-directed account as well. So we'll go ahead and dig right into it. Some of the interesting things that we're seeing trend-wise in 2020. So the first one being short-term financing. So this is where the retirement account is acting as the bank and it is lending money. In most of these situations, we're speaking about to real estate entrepreneurs, to real estate investors. And so what we're finding is in most metropolitan areas that I'm aware of, 2020 has actually been consistently a strong year in terms of the appreciation in those metropolitan areas, a lot of competition on the investment grade properties, on the retail side. Real estate has been booming largely in 2020. Even with that being said, there are still kind of granular one-off type of opportunities that investors are able to take advantage of just based upon specific circumstances with a particular homeowner, et cetera. And so that's allowed investors to find really great deals even in a super strong real estate market. And so there's a lot of ways that you can get involved in real estate deals from a very passive perspective of just simply lending to other real estate investors. So most typically what we're seeing is that the self-directed accounts are providing short-term, kind of more temporary financing for these investors that are accumulating properties. Because one of the reasons why they're able to get these hot deals is that they're able to perform and close very quickly with these sellers. So this real estate entrepreneur will say, I realize you have a problem right now, Mr. and Mrs. Homeowner. You just lost your job. You need to sell this property yesterday. I can actually close on this in a week or 2 weeks, or whatever can be reasonably accomplished with getting a full real estate closing put together. And so they need access to that short-term financing if they don't have the cash to close that deal. So these self-directed accounts can provide the solution of what I consider kind of the takedown money for these real estate investors. It's a $160,000 rental house. And so the self-directed account has that $160K plus in cash. It can fund that closing, gets a first position mortgage, promissory note, kind of full real estate closing there. And then many times after a few months, these real estate investors are going to refinance into a longer bank loan, which probably has more desirable terms. It's going to be a longer term loan. It's going to be probably a lower interest rate that they're paying to that institutional bank. And so that becomes kind of a win-win. So the self-directed account can make money on the upfront financing. The real estate investor has access to that quick capital, and then it can go and find less expensive capital at some point in the future. Now, also from time to time, we're seeing off-market real estate transactions where, again, there's a need for that extremely short-term financing, and self-directed accounts can be involved in that transaction as well. So most of the time what we're seeing is that it is what's considered a wholesale deal. So there's essentially three components to the wholesale deal. There is the seller, who we'll call entity A, is willing to go under contract with the wholesaler, which is entity B. And the wholesaler many times is not actually going to purchase the property, but simply sell the contract, sell the right to purchase the property to entity C, which is what we'll call the end investor. And so with that, depending upon the state, depending upon the attorneys you're working with, the rules and the regulations for your area, many times the A-B transaction between the seller and the wholesaler is a situation where there will need to be standalone capital for that to be its own real estate closing. So wholesaler B will technically actually need to close its own purchase and then simultaneously turn around and sell that property to entity C, which is the investor that's going to make it a rental property, for example. So ultimately, your self-directed account can provide the financing for the A-B transaction, and then typically the same day when that B-C transaction takes place, your money flows back to you along with the profit for essentially renting your money, again, many times for that single day use. So depending upon the competition, depending upon the state, the rules, the regulations, what we're seeing most of the time, and also the amount of capital that's being deployed, is usually the fee is somewhere between $500 to $2,000 for the fee for this transactional financing type of scenario. So again, kind of an atypical, kind of nuanced off-market real estate deal financing transaction, but it is something that we're seeing some clients work with their professionals to structure that deal. So just a little food for thought. And again, we're not suggesting any of these as appropriate for your retirement account. We're really just sharing with you different strategies that we're seeing out in the marketplace. Now, next is the idea of buying rental properties. And so that might be a little bit surprising, at least for some of you. Again, we just spoke about how smoking hot the real estate market is. And, in a perfect world, you're able to buy into asset classes when they're not, when there's not a lot of competition, when they're not at all-time high prices. But there's a couple of reasons that we're hearing from clients as to why they are interested in buying even in a high real estate market. And so the first one is there's a lot of concern amongst our clients about the inflation waves that are coming and what that's going to look like for the value of the dollar. So their concern is if they're not in hard assets, their capital, their retirement account will become less and less valuable over time. And if we have significant inflation, that could really severely deteriorate the value of their investment dollar, which of course would really hamper their ability to hold value, so that when they pull money out of their retirement accounts, that money um, will be a sum of money that will allow them to be able to retire and to pay the bills that they need to pay for. So inflation is always kind of that tricky game that we're all aware of in the investment space. So inflation's number one. Point number two is that there is still the ability to buy assets at a discount. So with mutual funds, we understand if a mutual fund or an ETF is selling for $100 a share, we are going to be purchasing for $100 a share if we are interested in purchasing that asset. Now, conversely, if we are purchasing a rental property, then if that property is in a neighborhood where the similar properties are going for $200,000, for example, but you're able to negotiate a better deal, you're a strong cash offer, or you kind of found out through this deal through the grapevine, and you're able to buy that property, let's say for $170,000, you are purchasing at a discount, obviously, to similar properties in your neighborhood. So there's still the ability, if you put the work in, to be able to buy with what we always like to refer to as a margin of safety. So that just makes your investment that much stronger moving forward. So certainly it's been a very unique year in every way possible, but we are again kind of seeing some trends and some things that are happening which are allowing rental properties to be purchased at a discount if it's let's say a landlord, it's an investor of some sort that is willing to put in the work, and it's willing to go to the meetings and network with people and let everyone know the types of deals they're working for. There's two reasons that we're seeing that landlords are actually selling their properties currently. The first is undercapitalized landlords. So for those of you that have been following us for a number of years, I've been voicing concerns about this trend we're seeing of investors coming out of the gates with no experience in real estate investing, kind of limited working capital, and going out there and getting levered to the hilt. If they can borrow 95% of the money for a transaction, they're going to borrow 95% of the money for a transaction. And we're all really interested in the scalability model of landlords. It's better to own 100 houses that make a couple of bucks a month than it is to have 10 houses that are free and clear or have very little debt, because quite frankly, I think we're kind of in this social media world of, it's kind of about appearance and again, kind of being able to showcase the scalability and the prowess that you have to build this kind of substantial business. Certainly nothing wrong with that, but that has led certainly to some very undercapitalized landlords. They're levered to the hilt. They're not getting payments from some of their tenants due to everything happening with the pandemic. And that is really creating significant stress on their portfolio. And so ultimately, some of those landlords are essentially being forced to have to sell off some of their assets. Hopefully they have equity in them so that they can at least profit on the exit. But that's definitely something we're seeing a good bit of. So undercapitalization of landlords. Also just simply fear of the unknown. Again, I spoke about at the beginning of this, there's kind of the theoretical stress test, and then there's just the reality of actually living in it while you're going through it. And so what we're seeing is that, obviously nobody knows what's going to happen with the pandemic. Nobody knows what the economy is going to look like, even as, hopefully the virus subsides and the health concern is not as much of an issue moving forward. What if there's another pandemic at some point in the future? This is kind of creating this fear of the unknown. And so it is forcing some real estate owners to be able to kind of recalibrate what their goals are, where they're going with their portfolios, and decide that Maybe they're going to have a smaller portfolio that isn't as levered up, that maybe is a little bit more diversified even in the real estate market, where they're looking at different parts of town or different real estate markets as a whole. So it's just, again, an opportunity for us all to take stock of what's working and what's not working. So the next concept is digital assets. And frankly, a few years ago, I didn't know what a digital asset was. I still know almost nothing about them. But we are seeing more and more of our clients that are investing in digital assets, or sometimes called cryptocurrencies. And so a lot of the clients that are investing in that asset class are simply looking to further diversify their portfolio. So maybe they're investing in Bitcoin or Ripple or Ethereum, which are different types of digital assets that can be purchased. And so what's interesting when you look at kind of the history of recessions is that 2008, not only was it a very significant recession, the 2007-2008 recession, but it was also very unique in that essentially all asset classes essentially got clobbered simultaneously. Historically, what you find is that the asset classes are not usually, especially, as directly correlated as they were in 2008. Maybe that means the world is changing and that's where things are going in the future. Or maybe that was just simply based upon the fact that the real estate market was really at the center of the issue with the mortgage-backed securities and the adjustable rate mortgages and all the things that went into the challenges that we all kind of either witnessed or had to deal with personally for 2007, 2008. Obviously, the stock market took a huge tumble and took a few years to recover. And so ultimately, again, historically, that's very unique in that many times with kind of, we'll call them typical recessions, the real estate market does not necessarily get affected, or certainly not affected in the way that it did in 07, 08. And so some of these digital asset investors believe that digital assets may not be correlated to other types of assets, such as the real estate market or the stock market. They could possibly even be inversely correlated. So if other assets go down, maybe these digital assets go up, and vice versa. So it's an interesting theory. Again, I know nothing about this world, but it is something that we're hearing more and more from our clients that they're interested in. So in terms of other opportunities that we'll just kind of briefly highlight, again, we're seeing a lot of real estate-based investing in 2020. So with that off-market concept, we mentioned wholesaling earlier as a part of the equation for the transactional funding. So some of our clients find it prudent to actually do wholesale deals inside of their retirement account. There's also the ability to purchase properties with existing mortgages in place, kind of the sub-to or the subject to acquisition strategy. And we do have some content where we dig deeply into the pros and the cons of those types of deals. And then also a tremendous amount of syndication deals where real estate investors are wanting exposure to larger deals, such as apartment complex deals, retail space deals, usually multi-million dollar real estate investments. And so they're able essentially to buy shares into an LLC, and that LLC goes on to make the investment into the particular asset. So we're seeing a tremendous amount of individuals raising money to go out there and take down those larger commercial real estate projects. So that is a way to scale your portfolio in a very passive manner. So for those of you that are listening live, I do appreciate the time today. If you have any questions, anything you'd like to discuss live on the platform, feel free to type that in on the questions box. And if not, feel free to give us a call or email us. So again, I'm Sean McKay with American IRA. My email is Sean, SEAN, at AmericanIRA.com. And our office number is 828-257-4949. Excuse me. So we'll see if we have any questions here. All right, so the first one is, what are the penalties if I engage in a prohibited transaction? So that's a phenomenal question, actually one that I don't get as much as I used to. So the short answer is, I'm going to sound like an attorney, and I say that with love. Got some good attorney friends, and they're great resources. But as with many things in life, it really depends on the circumstances. It depends on the type of retirement account as well. Because oddly enough, 401ks, the penalties are less significant than IRAs. With IRAs, what we find is that it is so specific to the situation and to the severity of the prohibited transaction that's taken place. And it is also something where there's kind of an intent quality to it. So if you kind of accidentally created a prohibited transaction, and we're very unfortunate to have that come up in an audit, which is pretty rare. It's really going to be, oops, that apologies, that wasn't meant to be. A lot of times it's very light slap on the wrist. Other times, if it's kind of a recurring issue and something that it seems pretty likely you knew that you were intentionally creating that prohibited transaction, that can be more severe. But really, I've seen such an extreme range in case law, really, in terms of how the IRS, the Department of Labor, kind of all those governing bodies will react to prohibited transactions. So that's a long way of saying that it's almost impossible to give you a really defined answer for that. So I'm sorry. It can be significant, really almost completely wiping out your retirement account if, again, it was heavily, heavily egregious and consistent, and just almost looking as though it was tax fraud, essentially. Or it can be, frankly, not even a penalty at all, just simply asking you to remedy the prohibited transaction. So huge, huge range there. Can I provide a copy of the slides? Yes, absolutely. Thank you for joining us live. So if you, obviously being on this, you've registered for the webinar, you'll receive the audio as well as the slides themselves. So feel free to dig into those at your own convenience. So I appreciate everyone's time today. Thank you all so much. Again, hopefully you're all staying safe and healthy, and hopefully you're just, you're not as adversely affected as many others are. And hopefully we will see you at an event soon. Thanks so much. Have a great day.